The biggest risk to the United States economy was never the artificial intelligence bubble or some tech hype. It was never what was happening in China or which orange man was sitting in the Oval Office. The real threat is something much more boring, and it is something you have likely never heard about unless you went deep down the finance rabbit hole. And that is exactly why nobody is paying attention to it until it is far too late. If you have been wondering why mortgage rates refuse to fall while everyone talks about cuts, you need to listen up. If you wonder why stocks randomly freak out every few months like a caffeinated toddler, this is the answer. The Federal Reserve can talk about cutting rates all day long, but if financial conditions still feel tight, the answer does not start in Washington. It starts in Tokyo, and more specifically in the most boring asset on the entire planet, which is Japanese government bonds. The country best known for anime and incredible sushi has also been the duct tape quietly holding the global financial system together for 30 years. And that duct tape is starting to peel off the wall right now. To understand why Japan is so important, you first have to rewind the clock to the early 90s. 30 years ago in 1992, the massive Japanese asset bubble burst and everything collapsed. Real estate went into the dirt, and equities fell off a cliff, and Japan entered what became known as the lost decades. It was a 3-decade-long period of being financially stuck in the mud with no real growth and no inflation. It was like the entire economy hit the pause button, and nobody could find the remote under the sofa. So the Bank of Japan did what central banks do when they are completely out of options. They cut interest rates to zero, and then they went even further and cut rates below zero. When that was not enough, they introduced something called yield curve control, which sounds like a superhero movie title. In reality, it just means the government decided to cap long-term bond yields, whether the market liked it or not. Basically, the Japanese government superglued interest rates to the floor for an entire generation. For decades, Japanese government bonds yielded pretty much nothing, which created a massive problem for Japanese investors. Imagine you are a Japanese life insurer or a pension fund manager with a billion-dollar portfolio. Your own government bonds are paying you 0%, which is a great way to go broke slowly. This leaves you with two choices: stay home and accept no return, or go shopping overseas. They chose option 2, and they chose it in a very big way. Japan entered a multi-decade-long global shopping spree that made them the largest foreign holder of United States treasuries. They became the largest buyer of American mortgage-backed securities and the largest net creditor nation on Earth. That is just a fancy way of saying that Japan became the world's ATM. It is not because Japan just loves sending their hard-earned capital to America for fun. It is because the math actually made sense for a long time. Let me introduce you to Bob. Bob wants to start making some serious money through investing without using much of his own cash. So Bob goes to the Japanese markets and borrows a massive amount of money in yen at near zero interest rates. Then Bob converts that yen into dollars and buys United States treasuries that yield 4%. After paying some small fees and hedging costs, he pockets the difference for doing almost nothing. This is what the pros call the yen carry trade. Investors would borrow in yen at near zero interest rates and then invest in foreign assets that yielded higher returns. And when your borrowing costs are near zero, you do not just buy boring government bonds. You buy high-growth tech stocks, and you buy expensive real estate, and you buy into risky emerging markets. Basically, if it has a pulse and it yields more than 0%, these investors were buying it. That is why for years this trade became one of the single largest sources of global liquidity. At its peak, the yen carry trade was estimated to be worth trillions of dollars. It was like the global markets were running on free Japanese Wi-Fi, but the problem was that the entire trade relied on one single assumption that held the world together. Everyone assumed that Japanese yields would stay near 0% forever. But in 2024, that core assumption finally broke into a million pieces. The Bank of Japan ended its yield curve control policy and raised interest rates for the first time in 17 years. And then they did it again because they had to fight the inflation finally showing up, immediately following that second rate hike. The S&P 500 dropped 6% in a heartbeat. The Japanese index called the Nikkei 225 plummeted over 12% in a single day. That was the worst drop since 1987, and it was a clear signal that markets were officially spooked. Because when Japanese yields rise too, very bad things happen at the same time. One, borrowing in yen becomes much more expensive, so Bob's free money isn't free anymore. 2, hedging the currency risk becomes more expensive, which eats into the profit margins. Suddenly, that 4% United States Treasury Bob was looking at looks like a terrible deal. This was the beginning of the end for the yen carry trade. When the math flips, the capital flows flip right along with it. The money that flowed out of Japan for 30 years is finally starting to return home to Tokyo. This is what we call repatriation, and it is one of the biggest threats to your portfolio today. Investors are starting to realize the uncomfortable truth that the cheapest source of global liquidity is no longer cheap. For decades, Japan was not just some random buyer of American debt. They were one of the most consistent and price-insensitive buyers of long-term treasuries. And those yields on long-term treasuries are not set by Jerome Powell in Washington. The Federal Reserve only controls the short-term rates that happen overnight. The 10-year and the 30-year yields are determined by simple supply and demand in the open market. The problem is that everyone is staring at the wrong lever. Legendary investor Ray Dalio says the bond market is the backbone of all other markets. It is the risk-free interest rate that determines what every other asset return is going to be. When there is a breakdown of the supply and demand picture in the bond market, you see a massive shift. Long-term rates start rising relative to short-term rates, and the currency starts to wobble. That raises interest rates for everyone and puts the Federal Reserve in a very tight bind. While everyone is hyper-analyzing Jerome Powell's press conferences, like it is a new movie trailer, they are looking at the wrong end. The Fed has some indirect influence, but they do not control the long end of the curve. The United States is currently running trillion-dollar deficits every single year. We have to issue massive amounts of new debt just to keep the lights on in the economy. As this debt issuance keeps growing, someone has to show up and buy it. For the last few decades, Japan was a key part of that massive absorption machine. If Japan backs out, then yields have to rise significantly just to attract new buyers to the table. That is how you get a situation where the Fed cuts rates but long-term yields stay high. That is called a steepening yield curve, and it is bad news for almost everyone. If long-term rates stop cooperating, then this stops being a bond market story and becomes an everything story. When analysts value stocks, they use long-term yields as the baseline for their math models. When those yields stay high, the present value of future cash flows goes down. That means stock valuations compress, and the price investors are willing to pay for earnings drops. Even if a company is doing fine, the stock price can still crash because the math changed. The 10-year Treasury yield is the foundation of nearly every single asset valuation in the world. Mortgage rates are the perfect example of this reality. Mortgage rates are anchored to the 10-year yield, not the Fed funds rate. So the Fed can cut all they want, but if Japan stops buying our bonds, mortgage rates will stay high. Refinancing stays muted and housing affordability stays strained, and the whole system slows down. It is the same story for corporate credit, which is the bloodstream of the entire corporate world. In 2020 and 2021, companies were issuing debt like it was a Black Friday sale. But if borrowing costs stay elevated, we see risk appetite fall and growth start to slow. The United States benefited for 30 years from being on the receiving end of this carry trade. Now that trade is unwinding, and the backbone of the market is being reshaped. Traditional financial media ignores this because it is not clickable or easy to explain in a tweet. Nobody wants to hear a nuanced discussion about cross-currency carry trades and institutional reallocation. People want to hear about artificial intelligence or whatever NVIDIA did in the last 5 minutes. The narratives are oversimplified to tell you that one Fed cut will fix the entire world. That is the lie we are being sold today. Liquidity is not automatic, and someone will not always show up to buy our mountain of debt. If the largest foreign holder of our debt decides to take a step back, global liquidity tightens fast. Liquidity is the oxygen of the markets, and when it tightens, the cost of money changes everywhere. It affects your house price and your retirement account and the company you work for. The real threats in the markets are not the loud ones you see on the evening news. The loud threats are usually already priced in by the smart money. The real threats are the ones hiding in plain sight in boring places like the Japanese bond market. I want to shine a light on the issues that actually matter, even if they don't get the most clicks. If you want to know what is actually happening behind the curtain, you need to look at the math. Everything in finance eventually comes down to who is lending, what to whom, and at what price. For 30 years that answer was Japan, and now that answer is changing. Stay boring and stay patient, and do not get distracted by the headlines. Peace.